Hey there, I'm Sarah Zervos and I'm coming to you from Global Reach. You can find Global Reach on the Facebook page Global Reach Econ. You can also Google Sarah Zervos at Huffington Post and get access to a bunch of blogs that I've written recently. Now that we have that self-promotion out of the way, today we're going to reach down to Lima, Peru, where the International Monetary Fund is hosting its biannual meetings. The International Monetary Fund, or IMF for short, is an organization that was created right after World War II. At that time, it was 44 countries. Now it's about 188 countries. And these countries agreed to work together to provide an economic framework where they could try to prevent global crises of the like of the Great Depression. And then if these crises occurred, they could work together to find a way out. So when we have these biannual meetings, which I've actually attended over the last 15 to 20 years, you get a group of policymakers, which include economists, central bank heads, and monetary policy committee members. You can get treasury officials, and you get a lot of the private sector who comes along in order to try to figure out what's going on. Now, I have to admit, none of these affairs tend to be a bunch of jovial, optimistic outcomes. In fact, when you don't go to the meetings, you listen to the headlines, and every single time you end up getting a little depressed about the state of the world. This year's meetings are no different. In fact, yesterday and today we're getting headlines from the IMF stating that they're pretty worried about the distinct possibility that the world is going to dip into another global recession. This time they say the culprit is perhaps China, borrowing in emerging markets, and impending interest rate hikes by the Federal Reserve. So go back to what's going on in China. We've talked about China recently, and there has been a big credit boom both in China and a lot of emerging markets like Brazil and Russia, where companies borrowed a lot of money because they could borrow really cheap, they could borrow really easily. Fast forward to today, and their economies aren't doing so great. In fact, as you've heard, China has been in the news, with the possible hard landing. Brazil's in a definite bad scenario. Russia, despite all of its military efforts, is doing very poorly given the oil prices are so low. Now, when companies have been borrowing a lot and they exist in these countries where the economic prospects aren't so good, they run the risk of not being able to pay their bills, which is called the default. Now, if these companies default on debt, it's not just the bondholders who suffer. You could have company layoffs, you can have repercussions to all the investors who are in those companies, both domestically and globally. And that's why the IMF is worried that interest rate hikes, along with slowing economies, could lead to widespread defaults, and that could just be enough to push the world back into recession. Now, what are we going to do with our investments knowing this? Actually, there's not much to do in the next 6 weeks because, in fact, we just don't have clarity. Now, this is a warning for sure, and the risks are out there, but we won't know if the Federal Reserve is actually going to hike or not until December. Chairwoman Yellen has been pretty consistent in saying that she thinks it's time to raise interest rates, but they're acknowledging that there's really not much inflation and they're worried about the rest of the world. Similarly, China is a really big country with a lot of moving parts. We know it's slowing down, but we don't know that it's a disaster yet. So unless you're a day trader, I wouldn't be running out and putting money into the market or pulling it out. In fact, just think of yourself still as a long-term investor. And long-term investors wait until there's a distinct informational edge to tell you that you should be changing your asset allocation. So on that note, keep an eye out for headlines in China. Listen to the headlines on the Federal Reserve, and I will also be keeping you apprised of my opinion as these developments come out.